What is going on, Future Focus family? My name is George. We talk about investing on this channel, and today I wanted to talk about the market madness that's going on out there, and let's try to figure out exactly what's going on. A lot of the questions that I'm being asked is, are we going to go up? Is the market going to go down? Are we going to crash? Should I sell all my stock? Should I sell all my crypto? What am I to do? You got the Fed and IMF and Paul Tudor Jones giving all this bad news, talking about a recession is imminent. What does it all mean? So today we're going to go through some charts. We're going to go through some news, and I'm going to give you finally my thoughts on what you should do next, which if you watch my videos, is usually the same thing. You know, stay calm. But am I buying stocks? Are you buying stocks? I want to know in the comments below. We do content like this here on this channel. If you like talking about finance, if you're worried about what your investments are doing, this is the place you want to be. So hit that subscribe button. All right. Before we even get into all that, thank you for all the love and support. You guys have been commenting a lot on the videos, and I love it. If you guys got specific stocks or specific cryptocurrencies that you want me to cover and try to help you out and see if maybe you should invest in it or not invest in it, and you want a thorough analysis but don't have time to do it, let me know in the comments below and I'll make that happen for you. I love doing it. All right. So with all that said, let's just get right into it. All right. So before we get into the chart, let's just go look at what the market is doing as a whole. So right now, the S&P 500, it just went positive. Right before I even started this video, we were negative. So all the indices are positive as of right now. We have the Dow is up 0.97%. You have the S&P 500 up 0.26%. You have the NASDAQ up 0.09%. Just because it's up, it doesn't mean we're all good to go and we're in the all clear and you should start buying right now. That's not how it works. You know, sometimes there are funds that need to go and make purchases and start buying things because it's a mandate inside of their fund that, you know, when a certain stock or a certain fund hits whatever threshold, they have to buy, whether they think the market is a good time to buy or not to buy. So just keep that in mind. Gold is actually up today. It's been on a tear on the way down. And then you have oil, which is down finally under that $90 mark. We want to see that even lower. That would be a bullish event for the stock market if that were to go down. But if you want to play it the other way and you feel that oil is going to go up, then what I would do is invest in maybe some oil stocks, because there are analysts out there that believe that oil is going to be on an upward trajectory and that we have not hit the bottom in oil. So just keep that in mind. We have a war going on in a different country. You know, they control a big percentage of the petroleum and oil that gets distributed around the world. And when they put a stop on that, it kind of pressures all of the world, and the oil shortages end up rising as a whole because supply and demand. So let's look at what the cryptocurrencies are doing. Currently, Bitcoin is down 19,139. You have Ethereum is down 1.03%. Anywhere under 200, I'm making a small purchase, but I can see Ethereum going to about 600. That's my bear case. It could always go lower than that, of course, but my bear case based on charts that I've analyzed is $600 on the down end. But so far, we've been in this capitulation between 1,200 and 1,800, and even more recently has been between like 1,300 and 1,500. So we're kind of underneath that level right now with all the uncertainty that's going on in the market. So let's go look at some news. All right, what's going on in the we have market movers right now. You have Viatris, Amgen, Micron Technology, Carnival Corp is up. It was actually down earlier in the market. You have Wynn Resorts, Las Vegas Sands. Those are down. Some of the most active ones today are Uber. They got a downgrade today. You have AMD, which if you watch the channel, you know that's one of my favorites. They're down today, looking very, very attractive. You have Tesla that's down today. There's news on them, you know, that doesn't actually have to do with them that brings them down. They actually beat their record for sales in China, but yet you see them today and they're down. A lot of that has to do with the uncertainty between Elon Musk and what he's going to do with all of his his stake that he has with Twitter. Is he going to purchase it? Where's he going to get the money to purchase it? He might be selling stocks every single day, and that may be putting downward pressure on the stock because he needs that extra capital in order to buy Twitter. So keep that in mind. That could be one of the reasons that Tesla is down on good news. You have American Airlines. They were up 6% in the pre-market because of some good news they had. They increased their forecast and they said, their third quarter bookings were actually above average. So they upgraded their outlook, which made their stock go up, but it has regressed back down. And that's what I expect to happen to the entire market as a whole. I expect the entire market to come back down. It's going to jump up. It does that, something called turnaround Tuesdays. Every time there's a Tuesday, sometimes it does the opposite of what it happened Monday. Monday we were down. So turnaround Tuesday, you expect it to be up. Do I foresee it closing up? I do, but for the week, I still think we're gonna end the week lower than we came into it. All right. So let's look at some news from Paul Tudor Jones. Paul Tudor Jones believes we are in a near recession, and history shows stocks have more to fall. I heard I heard him and Jamie Dimon. Jamie Dimon, if you don't know, he's a billionaire. He said that we can see an extra 20% from where we are now down on the S&P 500. But billionaire hedge fund manager Paul Tudor Jones believes the U.S. economy is either near or already in the middle of a recession. I don't know whether it started now or it started 2 months ago. Me personally, George, I believe that it started back in July, but that's just myself. I don't know whether it started now or 2 months ago when asked about recession risk. We always find out we are always surprised at when the recession officially starts, but I'm assuming we're going into one. Some analysts, they talk about this 2023 being the time that we're definitely going to be in one, but don't assume that the word recession happens and then the stock market falls. We can fall a lot and then hear the word recession, and then we've already priced it in the market, and we could actually hear the word recession being thrown out and the market rally on it because it's already been priced in. That's why it's not good to time the stock market, because you may be waiting for a recession and think that the market is going to plummet and that's when you're going to buy. But being that the market has already come down over 20%, it may already be priced in. All right. So just keep that in mind. And that's why we're going to talk about what I've been doing. But GDP fell. That's gross domestic product fell in both the first and second quarters of the first readings for quarter three is scheduled to be released October 27th. So that's coming up soon. We'll talk about that. I'm actually going to be in California during that week, but I'll be on here. We'll talk about it. The founder and chief investment officer of Tudor Investment said there is a specific recession playbook to follow for investors navigating the treacherous waters. Most recessions last about 300 days from the commencement of it, Jones said. The stock market is down, say 10%. The first thing that will happen is short rates will stop going up and start going down before the stock market actually bottoms. What does he mean by short rates? He means the yield, the 2-year yield on the American bond. So the 2-year is a short-term rate. The famed investor said it's very challenging for the Fed to bring inflation back to its 2% target, partly due to significant wage increases. Inflation is a bit like toothpaste. Once you get out of the tube, it's hard to get it back in. The Fed is furiously trying to wash that taste out of their mouth. If we go into a recession, that has a really negative consequence for a variety of assets. Now, let me take a break right there. I need to let you know that third world problems right now. I have lawn maintenance going on outside. So if you hear some big sounds, it's just the lawn being mowed. Just excuse me and bear with me. All right. If they don't keep going and we have high and permanent inflation, it just creates, I think, more issues down the road. If we're going to have a long-term prosperity, you have to have a stable currency and a stable way to value it. So yes, you have to do something 2% and under inflation in the very long run to have a stable society. So there's short-term pain associated with long-term gain. All right. So just keep that in mind. We'll move on to something that JP Morgan said. JP Morgan says that too hot CPI that's the core price index, would put stocks at risk of a 5% tumble. With a dovish Federal Reserve pivot seemingly off the table after last week's employment report, risks for spectacular speculators are running high before today's release of the consumer price index. Anything above the prior reading of 8.3% would be big trouble for the stock market. It could work both ways. If we go higher or stay the same, it could be bad news either way. So it doesn't just have to go higher, even if we don't go down by as much as what they thought. So you got to think, in I believe it was May, we had inflation around 7.9 and we were trending downwards. But then we got an inflation number the very next quarter of like 8.1, which put us back up, which is not the way it's supposed to work if what the Federal Reserve is doing is actually working. So this feels like another negative 5% day. The team led by Andrew Tyler wrote in a note Monday, noting that the S&P 500 dropped 4.3 on September 13th when August inflation reading came in hotter than expected. The scenario is the worst case laid out as a rough guide for clients seeking to navigate the heightened market volatility around economic data. Unsurprisingly, data on inflation are exerting to a huge influence on the stock market. Plotting the S&P 500 performance against top 10 economic indicators such as monthly payrolls and quarterly gross domestic product. What does this mean? What does it all mean? So what the problem is with the Federal Reserve is that they look at things in lagging indicators, meaning that the info that they get is based on things that already happened. This is the reason that the Federal Reserve always pushes things too far. When we're going up and they're trying to get inflation to go up, they push us higher than we're supposed to go because they are looking at they're not looking at indicators that are in future. They're looking at stuff that already happened. So we're always going to overshoot on the way up. And sadly, on the way down, we're going to overshoot as well. So what does the IMF say? The IMF cuts the global forecast for next year and warns that the worst is yet to come. So the International Monetary Fund predicts global growth will slow to 2.7% in 2023. The worst is yet to come. And for many people, 2023 will feel like a recession, the report reads. In GDP estimate, again, gross domestic product, for the year remains steady at 3.2%, which was down from 6% seen in 2021. The International Monetary Fund predicts global growth will slow to 2.7% next year, and the worst is yet to come. More than a third of the global economy will see 2 consecutive quarters of negative growth, while the 3 largest economies, the United States, the European Union, and China, will continue to slow, the report said. In its report, the IMF laid out 3 major events currently hindering growth. We have, as you know, Russia's invasion of Ukraine, the cost of living crisis because of inflation, and you have China's economic slowdown. Together, they create a volatile period economically, geopolitically, and ecologically. So a lot of things going on there, a lot of things to digest. All right. Is it all bad? I don't know. This report right here has a different tone to it. It says, rejoice. We may be very close to a Fed capitulation. What does that mean? That we may be close to a point where the Fed is done raising rates and they may take a breather. They're not going to lower rates for a while. So if you think they're going to lower rates, it's not going to happen. There's my main man, Jerome Powell, right there. Warnings about monetary overkill by central banks are growing louder. This time, the insurgency is coming from within America's new Keynesian elite. And Keynesian is just a form of economics, a way of looking at the economy. That matters. It suggests that the Federal Reserve may be closer to a blissful policy pivot. There may be a massive bear trap rally in a battered global equities, at least until the bulls are hit by the oncoming stream train of deflating profits. Episodes of Fed tightening are often brutal for the rest of the world. This one is especially ferocious. The broad dollar index is at an epic high, which means slow torture for emerging and frontier markets with $4.2 trillion of debt in denominated dollars. There is $13.4 trillion of offshore dollar debt outside U.S. jurisdiction with no clear lender of last resort. Not only is the Fed rushing through jumbo rises of 75 points each meeting, it is also draining the global dollar liquidity with 95 billion a month of quantitative tightening. It has never done the two together before, and it does not understand how QE and QT actually works, as admitted cheerfully by Ben Bernanke. He's a big. He has to do with the Federal Reserve. He's a big name out there. It models it models Dean QT quantitative tightening to be a little more tight than the background noise. The San Francisco Fed says 2.5 trillion of balance sheet reduction equals a rise of just 50 points. Bond traders think the authors must be living on another planet. But that's a lot of news right there. What is the chart saying? That's we talked about all the fundamental stuff going on in the economy. What does the technical analysis tell us? And right here we have a chart. Let me get this out of the way. We pull up, let's look at the 5-year chart. Right now, we're in a capitulation period, consolidating here between 3,500 and 3,800. Now, if we come back to around 26 October of 2020, before this long bull market we had, this bull run we had there, I'm not really, we only had 3 days here to talk about, looking at this right here. So am I really taking these 3 weeks right here of this entire 5-year time horizon? Am I think like here we have 3 weeks that we're building on this same shallow road? Um, is this the level I'm looking at? Do I think we don't have lower to go? No, let's actually pull up the chart. So let's take a step back. Let's look at this 5-year, right? What I'm going to do right here is I'm going to go beneath here. So here we are right now, right? We're at this level, we'll call it 3599, right? What I want to look at is not even the top here. This is before everything shut down for COVID. This is right before it. All right. This level is 3380. We haven't come down here this far yet. All right. If we come down here, it would be like COVID never happened and everything's back to normal. And then we could start all over again. But before that happened, we had a few days of capitulation here. And this is where we could look at. And this, let me go a little bit lower. Right here, right about the $32.19 level. This is what I'm looking at right here. There was some consolidation here pre-COVID. There was some consolidation in the same exact area post-COVID as we were working our way up after that V-shaped bottom that you see right there. I could see us going back to this level. Now, if we were already overdue for like a drop during that time and COVID had nothing to do with it, then it doesn't matter that COVID happened and that was just coincidental. Maybe we were supposed to have this crash here that brought us all the way back down to the 2018 level of December. So what if we were to fall back down here to the lows during that time frame? That would bring us all the way down to 24.22, which would be that 20% drop from where we are right now that Jamie Dimon mentioned in his interview. So it's totally doable. All right. So if this were to happen, look where we are here. I'll draw this line right here. Now we're bouncing above this channel and then we get some negative news on the inflation data. And now we're trending below that. Now, what I'm looking at is if we can hold this level right here of 35.99, call it right now. If we can hold above that, then that could be the bottom, at least for the short term. If we get more negative news, the next place I see us going, it doesn't have to be right away, but if we're looking at a long channel, the next place I see us going would be, again, that 33.80. But ultimately, my bear case right now is 32.19. 32.36 was actually the correct number, but we'll just leave it right there. We'll call it 32.19 would be where I would not go all in, but put a lot of the cash to work during that time frame. What did I do today? Well, in my wife's portfolio today, I bought I used 10% of her cash and I bought into I think it was 38 different stocks. I just put $2,700 into it. She had 27,000 on the sideline. I just used 2,700 of it and put it to work. If we continue to stay around this area, I'll keep doing that until that's all depleted. But I'm not making any big moves. I'm just looking at stuff that I see attractive and looking at our term horizon, which is over 10 to 15 years. I'm looking at it and saying, are the stocks that I'm investing in right now, are they going to be higher today than they were during this time frame? That's what thing that we're taking into account when we're doing our investing. Is the stock market where it's at right now 10 years from now, will it be higher or lower? I believe it's going to be higher. I believe it's going to be a lot higher. I just don't think it's going to happen as fast as people think, because a lot of people came into the market during, right before or right after the big drop in COVID-19, and they started investing during that time. And during that time, if you followed this channel, we would tell you over and over, just be safe. Just because you see green, our emotions want us to get in there because of fear of missing out, FOMO. We want to get in there and we want to jump and make buys because we don't want to get left behind. But when the opposite is happening, this is when you need to be making more of your purchases. The S&P 500 is down over 25%. You have the NASDAQ down over 30%. This is when you need to start taking a look at things and saying, all right, that stuff that was risky before, are those companies still risky? Right now is not the time that you want to be doing penny stocks. This is not penny stock time. This is the time where you got to think, if we go into a recession, a lot of companies are not going to survive the recession. And what companies are going to survive it? Should you invest in McDonald's? Should you invest in Coca-Cola? Have those companies survived and proven that they can survive past recessions? Yes, they have. But again, those companies right there are not going to give you the returns that you would get investing in something like Google or Apple that has a lot more room to grow, because they're not even touching 10% of the total market share. They can take a lot more ownership of that market share if things were to change with a different company. So just keep that in mind. All right. Please subscribe. If you like this kind of content, please like the video. Comment down below again if you have a certain stock or cryptocurrency or anything like that that you want me to talk about. Please, please, please. I'm here for you guys. I love doing this for you guys. I don't get to get on here as often as I do, but when I do, I try to come with as much content, and the feedback you give me gives me more ammunition to come back and give you more information, if that makes sense. But as always, invest in me and press that like button. Invest in yourself and smash that subscribe button. It literally costs you nothing. Until next time.